This is quantum economics. This is David Roche. Inflation, myth or reality. There certainly is verbal inflation around. Transitory is probably the most overused word, which is dropping out of the mouths of central bankers like quack quack out of the beaks of ducks. But what does transitory mean? The US hit a 5% inflation rate, which is the first time for many, many years last month. And oddly enough, bond yields went down quite dramatically. So the price went up. So more inflation obviously means a bull market in bonds. And equities hit a new time high. So clearly the market is convinced that inflation is not going to be a long-term problem, and that the more we have now, the less we will have later, and therefore the higher asset prices should go. Well, inflation is actually not the real story. It is a consequence of the real story. The story has 4 chapters. First is the inequality, which will remain the durable and lasting heritage of COVID. That is inequality between the haves and have-nots in our own society, between the sexes globally, and indeed between rich countries and poor countries. That's here to stay. The second is deglobalization. Well, that means that instead of having lengthy supply chains, which are risky, we're going to have shorter supply chains, which means more things are going to be made at home. That actually reduces the risk, but of course it reduces efficiency, because what you are doing is substituting a less efficient supply chain for a more efficient global supply chain, which is the price you pay for security, for making sure that your goods and services do not get blocked by COVID, for making sure they don't get blocked in the Suez Canal, or whatever the causes. That is where economies are going. And essentially what it means is that you're moving to a national economic model where a much greater proportion of what you consume is going to be made in the country that consumes it, be it investment goods or be it the sort of thing you buy in a shop. Now, what that actually means is that globalization, which subtracted between 0.5% and 1% from manufacturing prices for nearly 2 decades, is going to go away. And therefore, the result of it going away is going to be that prices are going to increase much more rapidly, in part because domestic producers have got greater pricing power. The third chapter is the shift from liberal market economics to the economics of intervention, from Darwinian markets to the kind teddy bear markets of big governments financed by subjugated central banks. Now, what does that actually mean? Well, you can see what it means by looking around you right now. You don't have to wait for a forecast to come true. The sovereign debt burden of countries, which is the amount of money that governments owe, has increased by about 20 percentage points of GDP in a year. The deficits of developed countries are going to be running at 6 to 8% of GDP, even 3 years hence. And they're running in double digits as a percentage of GDP right as I speak. There is a shift, of course, that corresponds to those deficits occurring in central banks, because central banks, which were once independent, are now essentially the back door of finance ministries. And the finance minister, of course, goes in and out of the front door issuing bonds, and the head of the central bank goes in and out of the back door buying those bonds and printing money to do so. There is also going to be a redistribution away from profits towards labor. Now, in many ways, that's justifiable. If you look at the gap between what workers get paid and productivity, which how much more efficiently they were working over the last decade and a half or decade, you will find there's a 20% gap. In other words, workers are getting paid 20% less than the productivity which they achieved by working better. Now, of course, the workers were not always responsible for that productivity. That can be technology, shifting the production curve. It can be deepening of capital, which gives the workers more machines to work with at the same time. But nevertheless, the gap between wages and productivity is remarkable. And it was piled up in profits. Those profits went to make rich people even richer. I would comfortably forecast that the inequalities which I dealt with as chapter 1 are going to push governments into redistributing that income and redistributing the wealth associated with it towards labor. That, of course, is of itself inflationary because companies will struggle and fight to get that money back again by increasing their prices. The third chapter is overstimulation by big governments. Now, what do I mean by overstimulation? We know that essentially during the COVID crisis, it was important and it was necessary that governments would spend more money than they were taking in taxes in order to prevent demand collapsing because people were not working and were staying at home and because goods were piling up in factories, theoretically, in any case. Let's look at what I mean by overstimulation with a concrete example. It is, of course, defined by governments spending money they do not get. In the United States, which is the case in point, 26% of GDP was spent during COVID, both last year and this year so far, or 5.5 trillion US dollars on COVID relief. Probably necessary. Infrastructure expenditure, which the Biden administration is now getting through the legal process, the parliamentary process of Congress and the Senate, that's going to be another 12% of GDP, or 2.6 trillion US dollars. And the American jobs, the American family program, is going to be about 4.4 trillion, which is 20% of GDP. If you add all that money up and you divide it up according to how it is actually going to get spent over the next 10 years, then essentially what the US government is doing is adding 5 to 6% in terms of growth to GDP every quarter in 2021, 4 to 5% extra percentage points of growth of GDP in 2022, and 2 to 3% per quarter thereafter. Now, can that work? Well, there is only one way that it can work. That this money will result in the growth in demand, there's absolutely no doubt about it. As a central banker said to me the week before last, when we had the problem of printing money and giving it to households or giving it to banks, we had a huge transmission problem because we were never sure if it would get spent in the real economy or whether it would be simply invested in financial assets to make the super rich even more super rich. But now that we can give money to governments, we know it will be spent dollar for dollar. So it is extremely effective. So these huge figures, which I'm talking about, 5 to 6% in the near term of percentage points of GDP being spent in the economy by the government, will be spent. They will generate that amount of growth. In other words, what you're asking yourself is, can the supply side of the economy keep up with this demand side stimulus? And the answer is it could, theoretically, if total factor productivity. Now that's a buzzword which I have to explain. If total factor productivity increases by 3.5 to 4% per year, you could actually square the equation in which the supply side would keep up with the demand side without generating inflation because of excess demand. What is total factor productivity? It is the sum of everything that is produced by all of the capital and all of the labor, excluding extra inputs of capital, excluding extra laborers, extra workers being added to the pie, being added to the supply side of the economy. In other words, it's what you can get out of in terms of more out of a fixed amount of both labor and capital. Now, it's a very key measure of the ability of the supply side of the economy to keep up with the demand side. The maximum historical rate achieved by the United States economy has been, in the best quarters, in the best years, 2 to 2.5%. So you're asking that to increase, in some cases by double, or at least by 50%. Could that happen? Well, it could happen. There are various ways in which the economy could become more productive. One is if all the factories and all the production units which were found to be unproductive during COVID and are likely to remain unproductive, if they close and release resources to be reinvested in the economy, that could help. Online working can help because you don't have to commute and waste a lot of time every day. The retooling in CapEx, what I would call the replacement of labor by robots, took place in a big way during the shutdowns of COVID. The proof of that is the way the capital expenditure held up and is accelerating today. That can boost productivity because less workers working with more machines will actually be more productive than more workers working with less machines. But you do have to ask yourself, what becomes of all the workers that are now not needed because we have actually brought the factories home from China or wherever, and we have retooled them with robots. But that could help productivity. And then there is the shift in retail spending to online away from bricks and mortar, which is innately a much more productive way of doing it. You may like Amazon, you may like its owner, or you may not. But the reality is it's a lot more efficient at delivering what consumers want to buy than any bricks and mortar store. And then there is, of course, the less unproductive use of time in business because you're not going to be doing as much business travel. Many of the meetings which you would have previously attended can be done on Zoom or whatever. And therefore, you don't need the hotels, you don't need the airlines. These things are not going to come back in the same proportions as they were before. And they were singularly unproductive uses of capital and time. So they're the things that could boost total factor productivity. But there are many which may not, and which are quite likely to be detrimental. One is big government paying social income, i.e. paying people not for production or productivity, but because we think they should have a decent lifestyle. Handing money across as transfers is innately going to be inflationary. The big government is always inflationary. The social income idea of bridging the gap between productivity and wages through social income, through handouts, that is ethically perhaps justifiable. It certainly is with good intent, but do not confuse it with the productivity that you get from the savage Darwinianism of liberal market economics. Secondly, these governments are therefore going to continue having very large deficits, 6 to 8% of GDP at the very least in 3 to 5 years' time. They're going to be financed by the central bank at cost of capital, which is really going to be below the nominal rate of economic growth. So in other words, if GDP is growing in nominal terms by 3% or 2%, then the central bank has to finance the government at rates below 2 to 3%, because if it does not, then the stock of debt plus the deficits, if they cost more than the nominal rate of GDP, you can see in your own mind that the stock of debt will continue to increase exponentially. So essentially, the central bank has a new role, not just controlling inflation, which is very doubtful, because inflation can actually help reduce the stock of debt, but essentially financing government at a rate of return on those loans, which may be perpetual, which are below the nominal GDP growth rate. What that actually means is that there is an ongoing misallocation of capital, because capital allocated by free market principles would not be allocated to the same resources as government will put it into, and it would not be allocated at the rate of returns which subjugated central banks to the needs of government will actually issue that money at. In other words, capital is going to be mispriced at a much lower level than a rational economic model would dictate, and that engenders a misallocation of resources, not only capital resources, but also labor resources. It is in effect what we would call a zombification of the economy, which means that the rates of return being earned throughout the economy are not the rates of return which would justify the allocation of assets which is carried out in that same economy. And that automatically means low productivity, high inflation, and in the end analysis, very low growth and social satisfaction achieved by redistributing wealth and income rather than creating new wealth and income. So my conclusion, and that of quantum economics, is that the party can go on for a while, but it cannot go on forever. So the outcome is actually very negative. There will be volatility at the very least around the inflation story when it comes and goes. People will say, well, it's all going to go away, and people will say it's going to go on forever and get a lot worse. But in terms of the investments that one might think about, first of all, is alternative currencies like gold, even the much maligned at the moment digital assets like cryptocurrencies. There is no reason really to own bonds because as central banks struggle to hold down inflation, and as the markets realize that inflation is coming back, the markets will increase the bond yields at the longer end of the curve substantially. I would see, for example, the US 10-year yield, which is something like 1.47 today, being well over 2% in 1 year's time. So the steepening of the bond curve, called the yield curve, means that really long-term bonds are not an attractive investment, whether you're talking about US treasuries or bunds or Italian BTPs. These are actually shorts. The US dollar is going to start depreciating again in the trend line that it already was for the last 10 years. It has been pretty stable since Joe Biden took office because people said the US is going to have higher growth than anywhere else. Therefore, down the road, it will have higher interest rates. Therefore, we get paid to own the US dollar. But now you're approaching what I would call a flip point in the perception of policy. So a policy reversal point, let's call it that, at which more stimulus is seen as negative for the market, something that has to be financed. And the US is going to be incurring twin deficits, very big budget deficits, very big external deficits, which means it is going to have to borrow the money it needs to finance its spending at the government level. It's going to have to borrow it abroad. Well, when that happens, the first thing that happens is the currency goes down. And only when the currency gets to the bottom do people say, well, the next move might be up and I get paid to own debt in that currency. The second thing that happens is that interest rates increase so that investors get paid more, both for the currency risk and for the fact that when the currency touches bottom, they will then get both a yield pickup and a currency pickup to finance the United States. But what is sure is the twin deficits of the United States cannot be financed at current levels of the dollar and current levels of long-term interest rates. And finally, we come to the eternal question of when on earth will equities stop going up? Well, the answer to that is I'm quite humble, I don't know. I'm neither God nor a guru. But what I do know is that what I have described, which are the mechanisms out of which inflation will arise in increasing year after year amounts, is not a good environment for equities. People say equities are a hedge against inflation. They are not. Certain companies, like for instance, Google or Facebook or Amazon, have pricing power because they're dominant suppliers, and they can actually manipulate their prices in ways in which the generality of the economy cannot. So only if output prices can rise throughout the economy faster than input prices under an inflationary scenario can equities be said to be a hedge against inflation. And output prices cannot eternally rise faster than input prices as inflation comes back, particularly as many of the signs of inflation we are seeing are actually coming from the supply side of the economy, which will have a much greater likelihood of squeezing profits than expanding. So equities get hit by the fact that inflation does not actually boost profits down the road. It erodes them. And the second thing equities get hit by is a rise in the discount factor to allow for two things. Number one is the real value of money today, which will be earned in 10 years, is less if inflation is 10% rather than 2%. that means that the present value of profits falls. The second thing why discount rates have to rise is because inflation introduces cyclical risk. So instead of having this steady stream of growth and profits from the period like the Great Moderation, we have an unanticipated, unknown cyclicality of profits, which is a risk which must be accounted for in the discount factor, which reflects the cost of capital. So, for the moment, inflation is all the buzz, and it has split markets right down the middle. Some believe it's coming back, some don't. The use of the word transitory is perhaps the greatest sign of inflation out there, because it is used so often by so many officials to keep everybody on board and believing that it is itself verbal inflation. And in the words of Robert Graves, hell is when words all but lose their meaning.